Here are some of the key differences between traditional stocks and bonds and private real estate syndications and funds. Number one is barrier to entry. Anyone can invest in traditional stocks, traditional bonds. You just get a Robinhood account or any of those accounts, E-Trade, whatever, and you're it. You can start investing right away. Private real estate deals, the vast majority of private real estate deals, especially the ones that are worth a damn, have accreditation standards. You typically have to be an accredited investor, which means you either have an income of $200,000 to $300,000, depending if you're single or married, or you have a net worth of over $1 million, excluding your primary residence. There are some private real estate offerings that are 506B, but what I found is that most 506B offerings are typically really novice sponsors, first-time fund managers, first-time syndicators, and they're doing a 506B because they're trying to raise a bunch of money from poor people. The majority of the people in the network are non-accredited, and they have to go the 506B route in order to get investors to qualify for their deal. The second difference between traditional stocks and bonds versus private real estate syndications and funds is lockup period. Your investments are fairly liquid in the stock market, meaning you can liquidate at any time for any reason, no questions asked. It might take a few days to get the money moved to where you need it to go, but for all intents and purposes, it's fairly liquid. Versus private real estate syndications and funds typically have a lockup period where your money is illiquid for a decent period of time, anywhere between 3 to 5 to 7 years. Now, the good news is that you know this going into the deal. You know exactly how long that money is supposed to be tied up. It's also worth noting that in a lot of these deals, there is some sort of liquidity event, like a refinance that happens generally earlier on in the process, so that there is a partial and or full return of principal to the investors within the first couple of years. Again, this isn't always the case, but a lot of the successful deals that I've seen that are value add, there is some sort of refinance event early on in the process so that the investors get a good chunk of change back within the first couple of years. And really the third difference between stocks and real estate syndications is just familiarity and general knowledge regarding the two investment vehicles. Obviously, everyone understands the stock market, or at least understands the premise of the stock market, but a lot of people, a lot of investors, even though they might qualify, they might be accredited to invest into these types of opportunity vehicles, they simply have little to no knowledge that these investment opportunities exist. And if they do know they exist, they have very little knowledge or no network in order to get them access into these kinds of opportunities. And finally, a little bonus one for you here. There's a lot of barriers and a lot of roadblocks and a lot more hurdles with syndications and funds than there are traditional investments. And that's why, generally speaking, syndications and funds tend to offer much higher returns than your average stock portfolio or like an index fund. The return metrics that you'll see, or at least the promised returns for a lot of these deals, are generally quite good. And they really have to be in order to make it worth investors' while, right? Like, no one's going to invest into something where my money's tied up for 7 years, but I get the same returns as I do in the stock market. And so generally speaking, there is some additional upside to these syndications and funds versus stocks and bonds because of this additional, inconvenience, these other barriers to entry to gain access into these sorts of investments. Make sure to like and subscribe for more real estate investing tips and strategies.